Welcome clients, potential clients and general listeners. I'm here again with Drew Meredith talking about the month of June, but really the end of a financial year, another financial year, 2023 financial year. Welcome, Drew.
Good to be back.
Tell us what happened in the month.
It was, for the year, it was a tale of two halves, wasn't it? It was
Sure.
Massively volatile.
Surprised about the numbers at the end.
Yeah, very, very surprising. And the month itself was pretty solid. I think most equity markets, the US markets were up over 6% for June.
Yep.
Aussie's starting to underperform compared to the rest of the world. We're only up about 1.5%. But I think if I asked you what you thought the total return from the ASX was for the financial year, you wouldn't be anywhere near what...
Well, I don't know about the ASX, but for a balanced portfolio, I was totally off. I thought we were running at a 3 or 4.
Yeah.
And I think Wattle, we did a 9.7 for the year.
Yeah, it was over 9, and then the average was more like 7.
Yeah.
And a lot of the major industry funds were between 7
Everyone
and
apart
8%
from us
as well.
Yeah, the average.
Yeah, I mean Vanguard, so the balance, the basic average was about 7.5%.
Yeah.
And that's because you had both equity markets and bonds eventually turn around during the year.
Sure. Yeah, I mean the biggest downer for the year was probably bonds, and it was long bonds really got caught in that period.
And if you think where we were in July last year, that was probably the worst sell-off in, I don't know, many years almost, and most extended, that you saw the first half of 2022, everything falling, yields fall, bonds falling, equities falling. And
a page of red.
Yeah, exactly. And that was because we had essentially 12 straight months of rate hikes that began in May 2022. It feels like they've been going on for 2 years, but it's only been 12 months in a row.
Correct.
It's a little bit scary.
It's another year to prove this kind of proposition that portfolio construction works on a basis of constantly rebalancing. So you think about the year, when bonds had fallen off, we've increased bonds. When global equities looked like it was relatively weak, we increased global equities. So sticking to your knitting, rebalancing to the core, through whatever environment you get, good, bad, crisis, whatever, is still incredibly important, probably the most important thing in long-term portfolio construction.
And interestingly, in June last year was when all the headlines were saying it was the end of the balanced portfolio. So we manage most clients that have got objectives that want income and growth. We end up having about 40% in low risk assets and 60% in growth assets. But this time last year, all the experts were saying you can't buy bonds anymore, and equity markets are also in trouble, so you can't do a 40-60 yet. It turned out to be one of the better years in the last 20 for the balanced portfolio. Yeah,
that's right. So there's probably tweaks. It's not all just sitting at the macro level. There's a strategy within a sector. The sector you're talking about is fixed income. The question is, do you go long duration or short duration? So there's lots of decisions, and in the framework of making decisions about a portfolio, and you get to this point where you go, you still make the macro ones, but the micro ones are really important as well. So not having long duration in our portfolio has helped. Obviously, we've changed that now, and we've added long duration as interest rates start to normalise. And I think that's a better way to think about interest rates than any other. If you talk to most people, they have a view that interest rates are either going to go all the way back down and risk assets will go up, or that interest rates will keep going up and risk assets will get further affected. My view is probably this is more a neutral type interest rate environment where you put your money in the bank and get 4 or 5%. Inflation's not yet under control, but I wouldn't be surprised it is under control in the next 18 months. So if you think about this as more a neutral framework, then it's kind of easier to build a portfolio and think about the future.
Yeah, I think the issue is we kind of extrapolate what just happened into the future, and you feel like rate hikes are just going to continue forever. But it's clear that they're starting to slow, and bond yields and bond curves are starting to tell us that there's a massive risk of a recession, or growing risk of a recession.
So rather than this period being unusual, it was just the period that we had, which was really 3 years or 4 years of rates being close to zero.
Exactly.
If you look at the last 30 years, that was the abnormal period. We've come out of that period probably with little pain, really. If people can put on 7 to 9% in a balanced portfolio in that year, very little pain through that period to come out from an unusual interest rate market to probably something that's more normal.
And that's a bit disconnected from what's going on in the economy probably too. That we've seen GDP growth for Australia came out, it was 0.2. And probably the scary thing was the savings rate in the pandemic went up. So how much people were saving of their after-tax income went up to like 20% or more.
Sure. Yep.
It dropped to 3.7% in the latest quarter, which tells you people are running into or spending more of their money and running into their savings more than they were in the past.
Sure.
And this is coming right ahead of what people are expecting to be a rollover of these fixed rate mortgages that could have a massive impact on spending. But we still don't know, and that's why the number of outcomes, particularly with interest rates, is as broad as ever.
Yeah, you still have a subset of the economy that's struggling, right? Anyone that's over leveraged or bought a property in the last 2 or 3 years is kind of underwater. As you said, the savings rate has gone from 20 to 3. Did you say negative 3 or 3? 3?
3, just 3, yeah.
Just 3. So that needs to be worked through over the next 3 or 4 years. What happens there? We've got full employment, so people have got a job. If you think about the 70s, and my mum and dad always had 2 jobs, so there's always the avenue. The economy's strong enough to get a second job if they need to pay mortgages. But that's only a subsection of the market, which probably the news puts on the front page every day.
Yeah.
So I think there's only 1 out of every 3 houses has a mortgage. The other 2 are owned unencumbered, so they're not going to be affected. In fact, they're probably going to be better off because their money in the bank is now earning 5%, not 0%.
Retirees and all those groups that don't have mortgage, that's why the restaurants are still full. Everyone's travelling. You just had upgrades from like Ardent Leisure, which owns Dreamworld and Waterworld and these sort of parks. So so many people are travelling and unimpacted by it so far.
Yep.
So it's kind of, when the recession hits, it seems like it's going to hit certain parts of the economy, not everyone else. And
I spoke to someone yesterday, and they just back from Europe, and they went to 5 locations, and they said in every location they met a friend or someone that was from Australia.
Yeah. So it can't be too tough.
No, not at all. So any specific things over that month? Costa and Invocare have got takeover offers. We have held Invocare before. We bought it at float 15, 16, 17 years ago.
Yeah. Not part of our models, but just kind of this interesting takeaway that private equity firms are coming into Australia and trying to take more companies private in their pursuit of growth or pursuit of returns.
Costa's Costa family, or is that PE as well?
No, PE.
Is it?
Not TPG, I think Schwartz Group.
Yep. Okay.
So a global PE firm, private equity firm is trying to take over Costa.
Yep.
Just showing that there's more demand forever for companies that have got some sort of growth, and private equity has, as we know, massive balance sheets to
Sure, they raised a lot of money in the last 2 or 3 years to deploy. The question is, how do they deploy it? So,
and particularly in a low growth environment, it's going to be interesting for them.
Yep. We saw a FT article yesterday that said 1 in 6 fund managers may not exist in 5 years' time.
Yeah.
So that's probably, we know that there's a changing landscape of financial services, and fund management over the last 20 years has been an incredibly profitable exercise. There's probably a number of billionaires that sit in Australia that have made their money through funds management. They were billionaires. I've never been a billionaire, Drew, so I'm happy to use the word were if I had to. I was a billionaire once. Not quite. So that's interesting. It really just shows that the availability of investment options is ever increasing. The fees are ever decreasing. Access to DIY investors and our clients is on the rise.
And ETFs and passive investing continue to take off and grow exponentially.
Yep.
And that's why we're still advocates of combining both active and passive ETFs and funds, and considering everything, all the options we have, rather than going down one route or the other.
Yep.
But it's definitely, and failing isn't a positive, but the fee compression is a positive for investors because you're getting access to the same things at a lower cost. So I think that's the competition is good.
And the general increase in financial literacy helps that. There will be some, even in the last 18 months, there's been some examples where financial products have been sold to retail clients that weren't appropriate. But as the financial literacy increases, hopefully that decreases.
That's something you're committed to through your role on the Australian Investors Association board?
Yeah, sure. Australian Investors Association board. I've been on that only for a short period of time now, but as Drew would know, the founder of our business, the original founder of our business, the structure of our business was Austin Donnelly. He founded the Australian Investors Association and was all about investor rights. Investor rights is hard to execute, advocacy, but in general, it's about increasing financial literacy in Australia for all. So that's something that the Australian Investors Association is working really hard on, but there's so many other people that are working on that as well.
Something we're still committed to, whether it's helping with the Australian Shareholders Association, being on the podcast with Rask and Self Wealth. I think it's all very valuable and important part.
You know that 100%. So we've been brought up in this environment under Austin, which is all about, and then his son-in-law Ian Murdoch, about sharing information that can do good, not just making sure you charge for that information. But, so you can get that word out a number of different ways. Obviously, we're associated with Rask. You do a number of podcasts. We've been a part of the Australian Shareholders Association. On the board of the Australian Investors Association. We write content all the time. I think we help a lot of clients too that just come in and generally need help without selling them an ongoing service. So I think generally that's going to get better, financial literacy, and the products that people have been trapped in historically will probably decrease as ASIC increases their knowledge around products as well. But every opportunity to make a dollar, you'll find someone that's trying to,
and particularly around advertising too. They're putting more pressure on what can be advertised. I think is a good move.
Yep.
I think one of the interesting things that we saw, Australian Super managed to send their performance figures within 3 days at the end of financial year.
Sure.
But one of the big takeaways from that was that all the asset classes did well, but commercial property and unlisted property was devalued by I think theirs by 7%, and you're seeing this trend globally. So more and more properties are selling at a discount to their carrying or the value that they were purchased at, or the value that they're held on balance sheets. And I think you love New York, but there were cases in New York that some of these properties
not cheap enough for me yet.
30% discount to what they were being valued at a year ago. They were sold at. So
sure, but if you the same in residential property. If you went to Byron Bay right now, I'm sure what was sold 18 months ago, or even down the peninsula here, what was sold 18 months ago, you'd be buying probably at 30% discount.
Yeah.
Of course, property is illiquid, so you don't necessarily know the valuations where it reached until you do a transaction. And if you do that transaction when you're a little bit stretched, e.g. big commercial offices, the big offices are only owned by a handful of groups, so it's not a big market for a $500 million property. So if you go to sell it and no one's buying it, then of course you're going to take a discount. So
this is why the investment or the team at Atchison are important for our kind of investment governance when it comes to, if we're investing into unlisted property, we want to know that if there's a run of redemptions like there were during the GFC, that you're not going to get locked into this fund, that there are liquidity options and that there are, or we're going in listed options anyway. So
yeah, and they're good for deep dives. Some of that's not probably appropriate for this podcast, but there was one recently, just last week, that financial instruments are calculated or counted in net tangible assets of property trusts. So it's not just the property, it's also the financial instruments. So if you're locked in...
Swaps.
Yeah, swaps. Yeah. If you're locked in your rates for 10 years at 2%, then obviously there's a financial benefit when rates are 5%. So that financial benefit is calculated into NTA.
Yeah.
So when you look at NTA of a property fund, it might be $1, but 8 cents of that might be financial instruments, not the underlying assets. So it's something I didn't know. I've been in this industry for 25 years, and it's like...
it goes the other way too. If you're locked in at 4 and it falls to 2, then you have to market to market and lose money on it.
Well, it should. I'm sure that the board will find something with the auditors to not have that. But
and super interesting from our. If I had to ask you what the best performer in the last 12 months was in terms of sectors from in the Australian share market.
Sectors, okay.
Yeah, over 12 months, not 6. If it's 6, it'd be very different.
So 12 months, huh?
Putting under the pump.
Yeah, I have no idea. Maybe financials?
Financials, no. I mean, not bad, 8%, so probably on average. The tech sector, that's basically in the second half of the year.
I wanted to go tech at first, but
37% for the year. the tech sector. I think it almost matched the NASDAQ, sort of US.
That was because it was
tech
down
index.
80% the year before.
Yeah, exactly. It's coming off a low base, which I think is always
You're not
important.
advocating tech.
No. And the second best, so materials and utilities. So the boring old cyclical companies, utilities bounced on the back of Origin's takeover offer, of the idea to split Origin into two and invest more in renewables, and then materials. So the commodity sector recovered strongly.
Yep.
I think that was more the first half of the year, not the second half of the year.
Yeah.
And they were both key drivers for our model portfolio, where everyone will be getting all our clients will be getting their quarterly reviews shortly.
Yep.
And you basically had the ASX did about 9.7%. Our model portfolio returned about 15% over the same period. That's been the one we track internally based on all the decisions we make and then recommend. And it was kind of driven by this continued concept that it's about staying with high quality companies that don't stray outside the top 50 in Australia, and weighting them equally across multiple sectors. So ensuring that we're not trying to, at the beginning of this year, a lot of people talked about we need more in energy, we need more in commodities because they're cyclical and it's going to benefit in this environment from higher rates. Well, we kind of just stayed balanced rather than trying to swing between either.
Sure.
And historically it's paid off. And then, as you said before, rebalancing, buying the losers, more of the losers, not necessarily the bad losers, but buying more of the losers and selling part of the winners. This is just key to.
We use the word value. Yeah. We're more value investors.
Buy low,
we buy
sell
losers.
high. Buy low, sell high.
Yeah. Okay, great.
I think we could go through, as a quick turnaround from the end of financial year, that I thought there were 3 things we got right and 3 things we got wrong.
Okay.
I'll put the 3 things we got right on you, very broad.
Oh, yeah.
I think it's an important part of when
you're asking me what we got right.
Exactly.
I've probably highlighted that this constant commitment to rebalancing is really important. Throughout the year, there's been some times that you have questioned, or we have questioned that.
Yeah.
So sticking to this concept that equities or growth assets drive returns over a long period of time, even in crisis. So we've rebalanced quite strongly. So sticking to growth.
Yeah.
We got our timing right. So when people go, well, what's the model portfolio has done versus my portfolio, then timing's really important too. If you wait 8 weeks to get our authority to proceed back or get back to us, then we've already implemented and executed that recommendation straight away.
Yep.
So you have to think about timing. So I think we've got timing right. Fixed income we've talked about before. We have been short duration up until the second quarter of this financial year, and then we've started to add duration a third at a time. So we've added duration at the right time, and we've avoided a lot of the big mistakes. And there's been lots of big mistakes. So crypto was an easy one, but also some sector-specific ETFs, and that's a topic we should talk about. There is instruments that are low cost but are also dangerous. They have incredibly high volatility.
Yep.
So some of those sector-specific ETFs that have lost 30, 40, 50, 60, 70%, we've kind of been out.
And they were topical and popular at the time.
And sold to us. They're typically investments that are sold to you, you don't necessarily should buy. So I think that's what we got right through the period. You can do what we did wrong, Drew.
I mean, there's always, one of our golden rules is not everything will go right. And I think that's a good part of reviewing anything. So anytime you're investing...
If it's a golden rule, shouldn't it be that everything always goes right?
But then you have to be realistic.
It's not a rule, right?
Well, the whole point of the golden rule is that things can go wrong and you'll still get the strong compounding outcome at the end. I mean, one is, we talk about only having 6 negative performers. 2 of them were direct stocks. So this challenge of when you're investing directly into companies, being harsh on cutting losses when they occur, I think is one thing.
But that's emotional too, right? So
exactly.
If you think about the 10 clients that called you last week, they all talk about the losers.
Yeah, exactly.
Their portfolio's done really well, probably better than most out there. But the conversation, I'm sure, is...
The 2 losers.
Yeah, the 2 losers.
Where the reddies, wherever the reddies.
The good thing about losers too is that they decrease. They also reduce the influence on their portfolio.
Yeah.
So from a portfolio construction perspective, they actually provide some balancing. E.g., you can't lose it twice, and the influence on the overall portfolio is quite minimal. So that's when you get to how to sell them, then they end up being so immaterial to your portfolio, then they should be relatively easy to sell.
And that's the benefit of diversification. Not everything will move in the same direction at the same time. And if it did, then you'd be over.
Well, you wouldn't be
you'd have
diversified,
too much
would you?
risk. Exactly. And we forget about that a lot.
Yeah.
I think potentially, so we've had some property in the portfolio which has done reasonably well, whether that's retail or commercial property. We bought into that after it started falling, so we've probably been a little bit early, but we'll always be a little bit earlier, a little bit late to the party on some of these things. But I think there's still significant value there as you go through this period of volatility.
So you might buy a few times through the process.
Yeah, and then one we probably won't apologise for, given all of our clients are retirees, a majority of our clients are retirees, is a willingness to be more defensive.
Yep.
So buying fixed income or buying government bonds when they're yielding 4%, you've got a guaranteed 4%. You can get 5% on a term deposit. We're not afraid to recommend these things and take less risk if it's still going to help you achieve the income objectives you want, I think is a key part of what we always think about.
Yeah, so generally our clients want to take on too much risk.
Yeah.
Or they're taking on too much risk to achieve the objectives that they're telling us. Now, risk by nature creates volatility. Volatility by nature creates worry. And once you're worried, you typically do things that you shouldn't do, e.g. sell at the bottom.
Exactly.
So dialing the risk back is really important. If you've got enough capital, you can achieve your objectives, then why are you taking that much risk?
Exactly.
Cool.
A couple of investment highlights probably. I can go through two quickly. So we've been increasing our fixed income exposure, and while bond yields have gone up, which have impacted the kind of capital value of fixed income in the short term, the proof's in the income that's paying out. So Yarra is a perfect example where the strategy which invests
This
into
is the Yarra High Income Fund?
Yeah.
Yep.
Where it's returned 10% for the year, and the majority of it's come from income, and I think maybe a small part of the capital went backwards.
Yep.
But the income you're able to get buying into these bonds that are valued at below their redemption value.
Yep.
Is just giving you this massive benefit of diversification when you're buying into these asset classes. And then you had two boring, Telstra and Woolworths, hit 52-week highs in the last few weeks. So it's just showing you that people are flocking back to quality, boring, consistent earnings and reasonably consistent dividends.
But if you look at our Aussie Direct portfolio, that's a sum of, I'll call it value, you call it boring, but it's they're mature companies in a pretty constrained economy doing what they need to do. The excitement, we always think the excitement's probably offshore than it is onshore.
And the quality of growth offshore is, you can buy
phenomenal.
Microsoft versus, no offence to NextDC, which does cloud computing here, but Microsoft's a completely different story. It's a $3 trillion company and different quality. And that's always going to be our preference, particularly for retirees and income seeking.
Yeah, but don't give up on your Aussie value portfolio. We've been managing that for 20 years. It's done incredibly well over the period. It's probably provided as much, if not more, income than it has growth over that period.
Yeah.
But the stick to the framework. Our framework is 15 to 20 stocks. Every stock is about equally weighted. If a stock doubles, we would halve it automatically. If it's halved, we decide to sell it or double it. Make sure that we've got a good sector exposure and let the portfolio do what it needs to do over time.
And that's that diversification. Value here, growth overseas.
Yep.
Boring, interesting.
Yeah. Yep.
I had a basic investment concept to consider, which is just explaining what a REIT is, or a real estate investment trust.
I hope you're doing that. I'm not sure I can answer it.
We hold a company called Vicinity within our model portfolio. Vicinity basically owns a series of properties, including Chadstone, or a big share in Chadstone Shopping Centre here in Victoria, and then a significant amount of either regional or CBD shopping centres. So a real estate investment trust is basically a listed trust, similar to a managed fund.
So you buy it on the ASX?
Yeah, VCX is the code for that one. And it basically owns the management company and a share in each of these properties, or the entire property. So you've just got this wrapper that holds a whole heap of properties and assets on your
So
behalf.
rather than having an operating business per se, it owns direct real estate.
And then your income, they call it funds from operations. It'd be easier if you just called it rent pass-through or something. Okay. But you're just basically receiving all the rents being put together, the expenses are being adjusted. If they're investing in building more new buildings, it comes out of there.
Sure.
And then you get dividends based on, or distributions based on the rent that's being received by that trust.
Explain that, because the stocks that I own on the ASX are companies, and this is using the word trust. Is there a difference between a company and a trust?
Tax structure. So a trust does not pay tax in and of itself.
So franking, you don't get franking
no
from
franking.
Okay.
So you get depreciation benefits if you're owning property. If you've owned an investment property, your income, your assets will be depreciated over time. That'll reduce the taxable income that you get. But basically, all the rent is passed through and it's taxed in your own name, versus a company where the company's taxed, then paid as a dividend, which you're taxed on with the benefit of a franking credit.
So if I had the same assets in a company structure or a trust structure, which one would be better? Would I get more out of the company because I get franked dividends?
Depends on your end tax rate, on your personal tax rate.
Yeah, I think the answer is the same.
Yeah.
One, you'll get your dividend. If it's a 7% dividend, you'll get 5.4 plus franking, which adds 7.
If you're in a 0% tax rate,
the other one, you get naked 7. So, essentially it's same.
That was a trick question.
No, I just think a lot of people get confused about, I want franked dividends, I want franked dividends. Is that frank? Well, franking, they earn $1, then they have to pay their, which is 30% tax.
Then you get the credit back.
Yeah, then you get credit back. So, but a trust, they just distribute the 100. So which one's better? There's no real better or not.
No, it should be the same amount. That's the whole point of having the credit, that you're not penalised for that structure.
Correct.
The frank credit anyway.
Good.
And some more good news. So Annette Bulgens, I believe is how you pronounce her last name, is joining us on the 17th or 24th of July. Joining our growing team as a paraplanner, so helping provide advice to new clients that we're meeting every day. So she'll join Renato, Roshana and Fatuma within the advice team.
Great, she's got a great resume, ex-Towers Watson, which is a big asset consulting firm globally, so they had a financial planning division. I think they closed that up recently, so we've been able to get some talent. So
definitely.
We have an event next week, Drew, with Paul Tricchiani.
We do.
So Paul runs, he actually works for Invesco at the moment. When we first met him, he's a SVP, which is a distressed debt manager out of New York. Paul is giving a presentation at a dinner next week. Invesco has I think they call it a credit opportunities fund, which I like to call distressed debt fund, but the same concept that you spoke about before, where you're buying bonds at a discount. Essentially what his fund does is buy bonds at a massive discount. So he's looking at companies that, they've issued bonds at $1 and they might be trading at 60 or 70 cents, and then they are buying those at 60 or 70 cents, and then the company might need to raise capital or restructure to pay back the bondholders at $100. So we're quite passionate about this asset class. It's got really interesting risk reward characteristics. It's not widely available in Australia to retail clients or to wholesale clients. So to have Paul out here, and he's been a leader in this asset class for 20 years, is quite an honour.
So it's one of those unique diversifiers that don't come up all that often as well, and very opportunistic. So very much suited to this kind of recessionary environment that's coming, where companies or the value of their bonds change, not necessarily because there's a problem with them, but just because what's happening in markets and what's happening with confidence. So super excited for that.
Excellent. I think that's about it, Drew. I thought we should have Q&A at the end of this, and my dog has been walking around, so I think, do you have a pet at home?
I do have a pet, my beautiful snoring golden retriever, Margot, who just turned 7. We found a new dog walker recently, and I've never seen a skinnier or happier.
Dog walker?
Dog walker. Dog. In 7 years, so she sleeps all night, snores at the end of the bed, but super happy. I mean, we love dogs in this office. There's always one here every other day.
My dog Luigi is walking around here somewhere. He jumped up a couple of times. He's in the corner over here. So Luigi's a Lagotto, Italian truffle dog, like stocks, I suppose. When we got a dog, we had to do a lot of research, and my wife's allergic to hair, so there was only 2 real options: a poodle, and I grew up with poodles. There's no way I was owning another poodle, or this Italian truffle dog. He's never found a truffle. He's never really gone outside.
Not where you live.
No, not where I live.
I got a question for you then. This was going around the office the other day. What's your favourite meal?
Oh yeah, my meal.
Yeah.
Oh, my mum might listen to this, so I'd have to say her spaghetti.
Meatballs?
Yeah, maybe meatballs. I don't know. That's probably my problem, Drew. Is I like a lot of food. So, what's yours?
Well, there's a sandwich across the road here. Just a roast chicken sandwich.
A roast chicken sandwich
with mayonnaise. Can't beat it. That's it.
Yeah, like it.
Yeah.
Thanks, mate. Another good month.
Good to be here.
Thanks, listeners. If you have any questions, queries, ask Drew, myself, or our team throughout the period. Thanks for listening.